Well, hi everyone, Sean Humphreys here. Welcome to All Things Retirement. In this installment, we're going to talk about beneficiary designations. And it probably on first review, it seems like a straightforward topic, but actually it can get complicated. It is a topic that should be reviewed on a regular basis. And the kind of designation you choose can change over time based on family circumstances. And there are some landmines you need to be aware of when it comes to beneficiary designations. So we're going to cover those topics in this video. Now, if you're new to this channel, make sure that you hit the subscribe button. We're posting content all the time on different aspects of retirement planning, as well as general wealth planning strategies. And so if you don't want to miss any of the future content, make sure you hit that subscribe button. Now, when we talk about beneficiary designations, let's talk about the three main ones that usually come to mind for people. So the first one is just a straight beneficiary designation on a RRIF account. We're going to talk mostly about RRIF accounts, but some of the comments I'm going to talk about today will carry over to RRSP accounts, and I'll make a few comments about tax-free savings accounts further on in this presentation. So we can have a beneficiary listed on the RRIF account, we can have a successor annuitant listed on the RRIF account, and we can have the estate listed. Now, what's unique about these three is a successor annuitant applies specifically to a RRIF account, whereas the beneficiary designation and the estate designation here can apply to an RRSP account as well. So let's first talk about the successor annuitant designation. Now, what's unique about this designation is it applies to a RRIF account. You don't have this designation with an RRSP account as an example, or with a TFSA account. Now, there is a successor designation for TFSAs, but it just serves a different function. So successor annuitant is something that you can put on the contract for a spouse or common law partner, so you have a partner. And the biggest advantage to the successor annuitant designation is upon your death, the account basically just reverts to the surviving partner and all the income payments continue. Now, where that's really important is usually in a first to die situation, couples want to make sure that there's income continuity. There's a bunch of expenses that get triggered in a first to die situation, and the family has to pay bills, and the last thing you want to see happen is for income to be interrupted from a RRIF account as an example. So there's no change to the income, and the surviving spouse simply just takes over the account. There's no probating of the account. It's a very seamless process. And typically with all these changes with your financial institution, if there's a beneficiary designation or successor annuitant or successor on the account, usually what's required is simply just a notarized copy of a death certificate, notarized copy of a will, and for the most part it's a pretty quick process. Okay, so that's in a situation where you've got a partner and the legislation allows you to continue those income payments, and like I said, very critical in a first to die situation. Now, when you think about the account itself, not only are income payments continuing, there's continuity in those payments, but 100% of the account rolls over on a tax-deferred basis to the surviving partner. And when we say tax-deferred, all we mean is that there's still a tax liability attached to the account, but that tax doesn't have to be paid until actual income comes out of the RRIF account to the spouse. Okay, so that's the successor annuitant. Now what I'd like to do is take a little bit of a look-see at beneficiary designations. So rather than listing someone as a successor, you list them as a beneficiary. And you can list your spouse or partner as a beneficiary on the account. The big difference is upon your death, the account that you have basically gets locked down. All the income stops and that account's frozen. And at that point, with a beneficiary designation, your partner can make arrangements to do a tax deferred transfer of your RRIF account or your RRSP account into a RRIF or RRSP account in their name, and there's no tax triggered upon that transfer. So a beneficiary designation for a couple situation where immediate liquidity and income continuity is not critical can certainly work. And again, you get the benefits of the account passes free of the estate, there's no probate costs, very little in the way of legal or accounting fees, very simple, kind of elegant settlement process that's available for you. Now, when it comes to beneficiary designations, normally what I've seen over the years is you'll have your partner or spouse as the primary beneficiary of the RRSP account. But you can also have multiple beneficiaries. You could theoretically have a spouse or partner as a beneficiary, but you could also have children, as an example, as beneficiaries on the account. Now, normally when it comes to children, what parents usually do is they'll have each other, the husband, wife, or partners, as the primary beneficiaries on the accounts. But in a situation where they're both gone, they die prematurely, then they might have what are called contingent beneficiaries. So there's no primary beneficiary living. There can be contingent beneficiaries, which may be the children. And that can actually be listed on your RRIF account or RRSP account application form or even TFSA application form. Now, the benefit of doing that is that the account will go directly to those beneficiaries without having to pass into the estate, where there might be some probate costs, delays, and administrative charges as an example. Now, tax is a different matter, and I'll talk about the tax impacts in a minute. But you can list your kids as beneficiaries. You can have multiple beneficiaries, and it's a quick, seamless way of getting money from the estate or from the accounts to those beneficiaries. Okay, so let's take a look at the next area, and that relates to the deferral of tax. Now, generally speaking, on a first-to-die situation where there's a surviving partner, the spouse or common law partner will receive the money on a tax-deferred basis, either to their own RRSP or RRIF account, or they'll just use the account that was set up under a successor annuitant that's already in place. And there's no big tax bill that's triggered on a first-to-die situation, and income will continue, like I said, with a successor annuitant if that's on the account. There are a couple of exceptions to the tax deferral. So if there's a financially dependent child listed on the account or grandchildren under the age of 18, there can be a rollover of assets on a tax deferred basis. And as well, if there's a financially dependent, mentally or physically infirm child on the account, that can lead to some tax deferral, and grandchildren also apply under those guidelines. So those are rare exceptions, but they are out there. But principally, deferral of tax on a first-to-die, on a last-to-die situation, that's when the tax bill typically gets triggered. So let's take a look at a bit of a schematic. So if there's no spouse or partner, keep in mind again, money gets transferred tax deferred if there is a partner to the surviving spouse. But if there's no spouse, let's say this RRIF account has $200,000 in it. When there's a last-to-die situation, no surviving partner, that becomes taxable income. So the $200,000 becomes taxable. Now that's a different issue than beneficiary designation. So in this scenario, you could have, on this RRIF account, you could have 2 children as beneficiaries, and that money can go directly to them, pass free of the estate. There's no probate costs. But even though you're saving on probate, and even though the process is relatively quick, there still would be a tax bill attached to this $200,000. And this is the first of one of the landmines that can take place with beneficiary designations. So in this situation, let's say there's a tax liability, I'll just say 50%, and there's a $100,000 tax liability on this account. That tax has to be paid at some point in time. So you can envision where there's a beneficiary designations of the 2 children. The financial institution here is not required to withhold back tax. So they will pay the $200,000 equally between the 2 listed beneficiaries. And now the kids have the money. There was no probate costs. It was administratively very clean, very efficient, and they now have the money. A few months later, the executor is now filing the year of death tax return and realizes that there's a tax bill attached to that $200,000, and they don't have enough money in the estate to pay that bill. Now they're going back to those beneficiaries to see whether they can get some of the money back to pay those taxes. Clearly, that would be a difficult situation, right? Where you've got a scenario where maybe the kids have already spent the money and now you're looking for additional assets from them to pay the taxes that are due. So this is one of the areas where the minute you start going down the path of contingent beneficiaries or listing the kids as beneficiaries on the account, you need now to start talking about how are you going to handle the costs of estate settlement, which will be probate fees, administrative legal costs, and tax costs, which could potentially be the biggest share of the costs attached. So you need to have a game plan, and you can use your lawyer or your financial advisor to help you with that. We do that all the time with our own clients, trying to figure out the best last-to-die scenario in terms of beneficiary designations. So let's quickly summarize what we've talked about so far. So we've got primary beneficiaries, typically your partner. That money upon your death goes tax deferred to the surviving partner or spouse. If you have a RRIF account and you want to keep the income payments going and the account not being locked down on death, then you want to use a successor annuitant designation. Now, when there's no surviving partner, let's say a last to die situation, you can be listing your children as beneficiaries, like I said, and what that does is save probate costs. It's very efficient. But it doesn't deal with the issue of taxes. So that's one of the reasons why we say to clients, and I've already alluded to this, make sure that you have a bit of a family powwow, or at least a powwow with your advisors, to determine, in a last to die situation particularly, which options make the most sense. Do we have the money go to the estate, or do we have it go directly to beneficiaries? So let's take a look at the last option, which is the estate as a beneficiary of these assets. So this is the critical question: when would you list your estate as a beneficiary? And there are a lot of voices out there saying, don't do that, have listed beneficiaries, look at all the benefits, like we've already talked about the benefits. But there are some really valid reasons that you would list your estate as a beneficiary that actually would be over and above the negatives, which would be probate costs, delays, legal and administration fees. So what in the world would justify the estate as a beneficiary? So let's talk about some of those. Well, first of all, there could be some family issues. That's just the reality. For not all families are completely harmonious and all their relationships are great and it's kumbaya. And if there are family issues, second marriages, a lack of family harmony, sometimes in a last to die scenario, you actually don't want assets going directly to intended beneficiaries. You want the money to first go into the estate, for there to be a cooling off period, to give your executors some legal protection in terms of next steps, and you actually have the estate begin to distribute those assets. So I'll give you a classic example. The example I just used previously, which is technically if you have a listed beneficiary, particularly the kids, on the last to die situation, there's no requirement for the financial institution to withhold tax. That's a bit of an anomaly in the tax code. So if you don't have family harmony and you've released all the assets to the beneficiaries, and then months later when the executor is doing the year of death tax filing and they're looking for money, that can create real strife between family members. It could create some real difficulties for the executor. It's just not a good situation. So if there's even a little bit of a hint of a lack of family harmony, I normally recommend to clients, listen, just use the estate as that firewall, allow the executor to get things dealt with, taxes, any other costs. Once the dust is settled and all that stuff, and they feel everything's been attended to, then they'll begin releasing money to the beneficiaries, which may be the kids. The tax has been paid, all debts have been looked after, and things are clean. Now, the other reason that you'd have the estate is there might be money going to a trust account. So many times clients will spend a lot of time thinking through their legacy aspirations around grandchildren, maybe community activities that they've been involved in. They want to support charities. And so they have money going into the estate. And some of that money to fund those objectives might come from RRIF or RRSP or TFSA capital. And if that's the case, the money needs to go into the estate for the trust to be funded. So your will gets drafted, the trust is embedded in that will, and the only way that that trust can be funded is for the assets to flow through the estate. So again, the estate acts as that administrator to make sure all those things happen. And also, having money going to the estate in a second to die or last to die situation does offer additional protections for the executor. Again, I go back to the situation where there may not be family harmony, and the executor is being pressured by beneficiaries to release money too quickly, and they end up making some decisions just to try to keep the peace, but then it causes them problems from an executorship standpoint down the road. And people need to remember that a couple of the fastest areas of litigation growing in this country is litigation against executors or powers of attorney executors defending themselves against litigation from family members. So the estate can be a very viable option for these reasons, and there are other reasons as well. Sometimes creditor protection. So rather than money going directly to the kids, you'll see families going into the estate and then into a trust so that those assets are creditor approved. Where would you do that? Well, you might have a situation where your children are in a business and you're concerned about bankruptcy and protecting those assets. It could be their marriage goes south, and so you don't want your hard-earned family assets going to that son-in-law you don't like it, and down the road you're worried when you're drafting the estate plan. you want to protect those assets for your kids and not for the kids of other families. And so that would be another reason why you'd have the estate as a beneficiary. So it's a complicated game. On a first to die, it is so simple. Obviously, heartbreaking for the couple, but from an estate planning standpoint, it's pretty simple. But once you get into a last to die scenario, it can potentially get very, very complicated. And then I just want to make a couple of quick comments about tax-free savings accounts. So like an RRSP account or a RRIF account, you can have beneficiary designations on these accounts. So typically if you have a partner or spouse, you can list them as a successor holder, which means that they could have their own TFSA, and then your TFSA just gets moved into their name as well. So you double up that, that tax-free savings account room, and they get the total value of both their account and your account together. The other option is a beneficiary. So with the beneficiary designation, it makes sure that the TFSA passes free of the estate, goes directly to the intended beneficiaries. But if you don't have a partner or a spouse, then the tax benefits of that account are lost. So basically, that account's collapsed. The money goes to the beneficiary. Now, if they have their own TFSA room, they might use some of that money to top off their TFSA account. But the account effectively loses its tax-free savings account characteristics at that point. Sometimes there's mistakes where people who have a partner list their partner as a beneficiary, and there is still a provision in the tax code, whereas as long as you do it before the end of the year, let's say you have a tax-free savings account, you've listed your spouse as the beneficiary and not the successor holder, then if you died in July, your executor family has until the end of the year to get that account rolled in to take advantage of the successor holder provisions. If you go into the next calendar year, you're out of luck in that situation. So it's important that you attend to those details. So the biggest takeaway here is making sure you're just keeping the information updated and making sure you're talking to your advisor about what designations are most appropriate for you. And that brings up sort of the last landmine that I wanted to talk about. And that landmine deals specifically with this whole issue of estate planning. So what we've seen over the years sometimes is people will spend, when they're younger, a lot of time on their estate plan, their will planning. They've got legacy planning through their will. They've got trust established. And some of the assets we're talking about in this presentation are going to be used to fund those trusts. And then years later, mom and dad go into the credit union or the bank, and the person at the bank says, I noticed that you have the estate as a beneficiary. That's a really poor thing to be doing because you're going to incur probate costs and delays. You should list specific beneficiaries on your accounts. And that sounds like a good idea, reduce probate costs and more efficient. So they do it. And so what they've done now is effectively eliminated all that hard work they did with their family and lawyers and advisors. Because generally speaking, when it comes to estate settlement, if you have a will that was, say, drafted 6 years ago, and then you go appoint different designations on a contract at your financial institution, normally it's going to be that last contract, that last annotation to beneficiary elections that's going to be taking precedent. So with a stroke of a pen and a signature, you've effectively done away with a lot of the benefits you were trying to achieve with that estate plan that you spent so much time and money working on. Takeaway: review periodically, powwow as a family, get your advisors involved. Don't make it a one-and-done situation. It does need to be reviewed every few years, or if there's been changes to your family circumstances. Well, it's my hope that you found this video on beneficiary designations helpful. And if you liked the video, make sure you hit the like button. And if you want to get future content alerts, make sure you hit the subscribe button. We're posting content all the time on quite literally all things retirement. As well, we have a useful link that takes you to our retirement coaching page if you want more information about our retirement coaching services, and some other links to different aspects of our website. Anyway, wishing you all the best in your retirement planning and wealth planning journey. You take care.